What is sequence of return risk and why does it matter? Hi, I'm Garrett Ray, financial advisor with the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to cover what sequence of return risk is, what impact it can play in your retirement savings when taking distributions, and how to avoid sequence of return risk in your retirement portfolio. Don't forget to hit the like and subscribe buttons here if you're so inclined to catch other episodes that we've done. All right, Garrett, let's go ahead and get to it.
Yeah, so sequence of return risk, what does that mean? So everyone knows that when they're in their years of their 20s, 30s, 40s, they're saving for retirement. They can withstand the ups and the downs of the markets. We kind of intuitively know this. However, we're really concerned about the return of the markets on that date of retirement. Let's take a typical age of age 65. Have you ever considered what would happen the year after you retired if the market were to go severely down or have a really strong run up? What does that mean for the longevity of your retirement? And we're going to explain in this episode of The Vault today how really protecting yourself against substantial losses in the early 5 years of your retirement can have a long-term impact on your overall nest egg when you enter your mid-80s to mid-90s. And so essentially what this is, Brice, is those first few years of your retirement are critically important because, think about it, we've now stopped our job. We are drawing off of those retirement accounts to live and subsidize our standard of living here. Sure, we've got some Social Security probably coming in, but for most people, that's not going to be enough for everything. So if we are subject ourselves to full market risk and we're also drawing down on those accounts, you can see pretty quickly how we can get ourselves underwater here in a hurry, and that is not a good thing for your long-term longevity of your retirement nest egg.
Yeah, no question about it, Garrett. Most people will be heavily invested in the market during their wealth accumulation phase of life. And that, for most people, lasts them from around their mid-20s or so up until their mid-60s until they retire. That's what we call the wealth accumulation phase of life. And during that time period, at least up until the mid-50s or so, 10 years before retirement, it's okay to be subjected to more or less the full volatility of the market, assuming that you don't need your money for 10 years or so out. That's what we call the time horizon. But when you get closer to your time horizon than that, your time horizon shortens down to 5, 4, 3, 2, 1 years. If you're exposed to the full volatility of the market and you're entering the wealth distribution phase of life, you've moved from the wealth accumulation to the wealth distribution phase of life, the market plays a different animal for you, and that's what we're going to show here. So we're going to put up a graphic that shows the McCoys and the Hatfields.
Two different families.
Two different families, and the age is that yellow strip down the middle. They're the same age. So they go into retirement, each of them, with $500,000. That's the number that you see there on the left side. The numbers that we're seeing here under the hypothetical net return of the McCoys is the actual return of the S&P 500 in 1979, 9.34%.
Right.
That 28.91% that you see is the actual return in the market in 1980. And this goes chronologically down all the way through 2009. So we can see those years that have a red circle around them for the McCoys are the years that there was a negative return in the market. So we have 1, 2, 3, 4, 5, 6, and that green one at the very bottom is 7, is the 7 negative years of the S&P 500 from 1979 to 2009. Well, the McCoys went through this in the proper chronological pattern. And we can see in this, by the way, you can see at the bottom here, this is factoring in a 4% rate of withdrawal, which increases with inflation at 3% after that, that they have by age 95, the McCoys have almost $2.7 million left to their name. By most people's standards, that's a pretty good achievement in retirement. Now, let's take a look at the Hatfields. And we see a different return here. We see in their first year of retirement, they see a negative 35.61%. Well, this is simply taking the exact same returns that the McCoys had and what the S&P had, again, from 1979 to 2009, but we reverse the order of it. So now if we want to see that 9.34% return that the McCoys had in year one, we've got to go to the bottom. Right. Of the Hatfields. So all we're doing is taking the same exact returns, just reversing the order. This shows you right here the impact that the sequence of return risk can play on your portfolio in retirement. So the Hatfields have that negative 35.61% return that the market had in 2009 in year one of their retirement, whereas the McCoys didn't have that until the last year of their retirement. Well, okay, let's go to the bottom here at age 95, where the McCoys have $2.7 million essentially left to their name. What do the Hatfields have? Well, they ran out of money at age 89. That's that red bar that we see there. So the same exact returns, just in the reverse order. This is one of the bullet points here to talk about was what impact can sequence of return risk play on your portfolio. There's not a better graphic that I've seen, Garrett, that shows it than this right here. So this is the impact that it can play. The next question becomes, how do we avoid sequence of return risk, Garrett, in one's retirement portfolio?
Right, Brice. And I think the graphic has powerfully displayed how if you stay exposed to the full risk of the market in your retirement years, it's essentially luck of the draw. If you have positive bull market years in those early 5 years or so of your retirement, you're probably going to be okay. But if you retire and the very next day the market starts turning downward, and you're in a cyclical bear market, which most of them last about 18 months, that can take a huge dent off of your retirement. So how do we prevent that? This is where having a financial advisor on your side is so important. You need to talk to your financial advisor about lowering your beta. We talked about beta in a previous Vault episode. Beta is a beta of 1, means you have the full up and down volatility of the market. We're looking in retirement to shrink our data below 1. So if you have a beta of 1, and let's say the market went down 30% that year, if you had a beta of, in your retirement portfolio of say 0.5, well, now you're not going down 30%, you're going down 15%. It still stings, but it's not taking that full brunt of the full downward thrust of the market.
Perhaps not detrimental.
Perhaps not detrimental. Right. And what we're looking to do here, you can talk to your financial advisor about tactical management versus strategic management. That's a conversation that we have with a lot of our clients. There's 2 different ways to invest in the market. We can get into that in another Vault episode. But you want to be invested in the market that's going to monitor what the market is doing versus a buy and hold strategy regardless of what the market is doing, which is essentially what the sequence of return risk demonstration showed. The other way we can do that is talk about moving some of your assets out of the market
into other types
types of vehicles. Yep.
Right. And that's how you avoid sequence of return risks. There is no way to predict what the market is going to do next year and simply pull yourself out of the market a year ahead of time so that you're avoiding those negative 36 years. The people who are successfully can do that are very limited. So you've got to have a strategy in place ahead of time and perhaps not be fully vested in the market. There's other vehicles that can still have somewhat decent return without taking the risk. And so that's basically covering what sequence of return risk is, the impact it can play on your retirement portfolio, and how you avoid that. I think that's going to wrap it up, Garrett. By the way, we did do another Vault series on the 11 different types of risk, sequence of return being one of them. So this episode here was just a detail into one of those. We're going to be doing a detailed video on all the 11 different types of risks. As those come out, you will be able to find those links up here. And for that summary Vault episode that we did, that link is right up here as well. That's going to wrap it up for this episode of The Vault. Feel free again to hit that like and subscribe button down here to catch all of our future episodes. Remember, the markets aren't going to wait for you. I'm Brice Payne.
And I'm Garrett Ray.
And this has been The Vault.